close. All right, try that now, Rye. Is that better?
I'm hearing you fine.
Okay.
How am I coming through?
Okay, good. Yeah, no, I think I got it. Okay, so that delay's
Okay,
gone.
perfect.
Okay, perfect. All right, we got it. Um, hey, man, that's live
Showbiz,
TV,
baby.
showbiz, man. I think one time I kicked my microphone off on live TV. I think I was on with Melissa Lee, and I was like, "Hang on, just one sec." I went under the desk and got it and put it back on. Like that's just hey, man, that's how it works. So, anyways, so welcome, guys. Let's just make sure in the YouTube room, you guys coming through okay. Just let us know on in the YouTube world if we're looking good, and we'll jump in here. We've got a lot to cover. Ryan and I worked hard on the pre-show notes here. So think about the questions and comments that you guys have about this market. What things that are going through your mind, things you'd like to see, maybe have us address for you. There's a lot happening. So, Ryan, why don't you kick it off from your point of view here, man, with all the geopolitical things, moving the markets. Why don't you kick us off?
Well, I think the big news item this week is the Fed, right? I mean, that's what we've all been waiting for. We all sort of knew what was coming, so no major surprises. Probably the only big surprise might have been how the markets reacted in such a positive way, right? Yesterday, I mean, we knew that expectations of a 50 basis point bump were coming down. We really weren't expecting that. I think they had said so much. The prospects of a 25 basis point hike were really strong. Again, we sort of knew that was happening. S&P rallied 1.5%. Growth stocks, the Nasdaq was up, I think, over 3.5% or so, and we're continuing a little bit of a rally so far as we're taping this. 20 minutes until close on Thursday, and so we're seeing some strengths in the market. And when you see the guidance from Powell and the Fed, again, we're expecting another 6 hikes from now to the end of the year. And they're really in a position, I mean, they have no choice when you look at what inflation data has been, where the economy is at. But certainly to me, I mean, again, with all the expectations in place, knowing what was going to happen, I'm a little surprised to see how strong the market's been from that. Because we haven't had any really good news, I'd say, out of Russia and Ukraine. If anything, some of their talks seem to have stalled a bit. Russia still dropping bombs and attacking some of these cities, and so nothing's resolved there, and the market's doing well. And from my perspective, it's a good thing. We've kind of talked about this over the last few weeks as it is in terms of where the economy is in some of these fears of impending recession, because you're hearing that more and more, whether recession, stagflation has come into the mix. But overall, I mean, the markets are doing well in terms of kind of how you're viewing the markets. And again, you're more of a, probably on the day-to-day basis, being able to, from your background and the technical side of things. I mean, how are you interpreting this latest move from some of the lows and the strength over the last 2 days?
Yeah, yeah. So I think we have a lot to talk about in terms of sentiment, and sentiment got really bearish, and rightfully so. And those of you who are kind of new to the markets, and I know I posted on various social sites that I don't normally do, so maybe some friends and family here. That this is typically how markets work, where things got so bearish with the spike in crude oil. You see what's going on at the pumps. You see what's going on if you're looking at either buying or refinancing a house, how mortgage rates are going up and how the Fed just moved and how it's kind of changed your day-to-day life. And there's a lot of factors out there that make you think that the market is in trouble and will probably continue to be so. But the way the market works is it's forward-looking. It looks ahead. And we had a very sharp sell down. I could probably throw a chart over here to put some context behind this. We had a very quick initial reaction to everything that's going on. Let me just pull this one over here. And that was, I would say, as we pop out here to the daily chart, this is the S&P, you had a very sharp move down from January into the end of January. Okay, and then there's been a lot of talk, if maybe you're somebody who's a little bit more knowledgeable in the markets, about a bear market rally, and all that means is a rally in the market that is in the context of a downtrend. They tend to be very sharp and very violent, because what happens is shorts, people who are making money on betting, are covering those shorts very quickly, and it's actually more of a greed thing as they're trying to lock in those profits, causing very sharp pushes up. Then what happened is we got another push down here as the Ukrainian situation continued to develop. But what you'll notice in the S&P, and as I bring over some of the tech stuff, and specifically semiconductors, I tweeted about this, even though we went to new low, the kind of price action, the momentum, the volatility, the sentiment, the momentum and volatility was waning. It was less. Even though we went to a new low, there was not as much urgency in the market as we saw back here in the initial push. Then we went into the Fed yesterday, and we had put money to work. We put money to work for clients yesterday in the afternoon. But I think just because of the selling that has evaporated, and I have a couple charts I can show you too, there's so much cash on the sidelines right now. There's record levels of cash. There's nobody left to sell. And the markets are forward looking. And what I'm saying is, yes, news is bad now, but markets are looking forward. So I think we were going to rally almost regardless of what the Fed did and said yesterday.
It's a good point. And I think for some of the longer term investors, and just trying to make sense of what's going on right now, because, and we'll get into this through our discussion today, and I'm sure moving forward, but we're in this I mean, I guess probably every time in the market is unique, right? But just with everything going on in terms of COVID the last few years, coming out of that, relative strength pre-COVID, strength through COVID after the dip, and then now having this global conflict that we're seeing. But your point as to the market being forward-looking, it's so critical to remember, because you get into these times, and I remember it vividly with COVID, right? I mean, it's probably about almost 2 years exact. I forget exactly when it bottomed out, but I think it bottomed around March 20th, give or take, of 2020. I mean, we had this just 1 month sell-off where you saw the markets going down 8, 9, 10%. And frankly, by mid to end of March, the news was probably the worst it's been. I mean, everything was shut down. The prospects were getting grimmer and worse, and the markets bottomed, right? They bottomed, and they essentially went up from there. And I know that a lot of investors were sitting there waiting. They're like, it's got to come back down. It's got to come back down, because there's just so much bad news out there. But to your point, the markets are going to be forward looking, and they're thinking ahead. They're acting ahead, and it doesn't mean that you can always kind of predict when that bottom is going to be. But what you can do is, kind of looking at the big picture. We put, as you alluded to, we put some money to work yesterday. Yep, it doesn't mean that we've struck bottom and it can't have more volatility ahead of us. But when you take a step back, and some of the the growthier areas of the market are down almost 20%, the overall market's down more than 10%. If you're a longer term investor, that is an opportunity. And to your point, the markets are going to be forward looking. You're never going to be, if you're waiting for that piece of good news to start getting money to work, you're too late, and you're probably too late by a lot, to be honest.
You're absolutely right. You're absolutely right. And I think you just look at some of the names that we hold in our portfolio. You look at the semis. Semiconductors, I think, are so important, and they're sort of the bellwether for technology and growth. And just to look at where we've been. This is the SMH. Okay, so let me just flip this chart over here. This is the SMH. This is the ETF that tracks semiconductors. So this is the COVID low. So this is March 23rd, the low that Ryan just mentioned. And if you look at the price move that we've seen in semis, I mean, guys, we're up 198% in an ETF. It's an ETF, it's not a double or triple leverage. 198% right now, peak to trough, it was 223%. And if we look at kind of context of where and how far we've come off from the very high, roughly, we could call it, we're 15% off the highs. So, it puts it in context, number one, how far we've come, how small, when you take a deep breath and sit back and say, okay, look at the shape of this, what I very much believe is a correction. And then the earlier point that I was making is, you see the initial push down here. That was very sharp. Then you get the bear market rally, and a few of my friends on CNBC, I'm listening to them say we're in a bear market rally. No, that's not how it works. A bear market rally is, again, when we go down very sharply and then come up very sharply. This has been different. This has been a loss of momentum, a loss of volume, a loss of selling interest as we're kind of processing a bottom. This is new money coming to work. I can feel it in the market. I know it. I've been through it. This is new money coming to work. This was short covered. And I think there's a difference, but there's a lot we can talk about with the technicals and the position of the market. Do you want to head into sort of the big thing that's driving markets right now is interest rates? And again, if we're talking to somebody who's newer or not as involved in the markets, I'd like to take a second and sort of explain what this yield curve spread is. Is that okay, Ryan? Or do you want to hit something before we jump into that yield curve discussion?
No, I think touching on the yield curve is important right now because I do think someone who's either hasn't been very active in the market or maybe has been sitting on the sideline this is I think now probably more than ever, in some of my career in terms of everything that's happening in the news that we're getting and in the point that we're at right now, it's really complex. It's really confusing because you have all this sentiment kind of pointing to negativity and even some data that's pointing that way. But there's just so much that we've gone through recently, with inflation, with Russia and Ukraine, with COVID. There's just so much there to process that I think if you're basing everything on historical norms or historical sort of charts, or if you're basing everything on history, you might be missing some things that are happening, kind of either beneath the surface or that we're not really using to rely on what's going to happen in the future. And I think it's for most investors now is really, really confusing whether you're sitting in cash or fully invested or somewhere in between. It's hard to make sense of what's going on right now.
Yeah. And the data, I'm kind of skipping around here a little bit. The sentiment has been so poor as we opened up with. And again, I just want you to keep in mind that this is how I think you effectively position. This is how we approach managing our client portfolios. It's a combination of watching the market in real time, watching dynamics, watching the flow, knowing the fundamentals, but also knowing the technicals. You do have to know the technical position of the market. And I think we should just step aside here 1 second before we continue on this point. We are portfolio managers. We are financial planners. We are positioning our clients for the long run, though we actively monitor the market in the very short run. I'm constantly watching the market. Ryan is obviously focused on bigger picture. He's very schooled at the investing time frame and financial planning, tax strategy. But my job as a portfolio manager is we are investing for the long run, but we're constantly watching what's going on in the short run because we're trying to fight for every 1% of return that we can get for our clients. But back to the economic point of view, like the sentiment has been so bad. So a couple numbers to throw at you. About 2 weeks ago, we got the Michigan Consumer Sentiment. They were expecting a reading of 61.4. It came in at 59.7. That was the lowest, I believe, since 2011. Do you remember when the U.S. U.S. debt rating got downgraded? Our sovereign debt, I can't even say it. Sovereign debt downgrade. Oh, and by the way, I'm holding this off until after the show. Happy St. Patrick's Day.
That makes up for the lack of green today.
I know. I know. There's a lot to set up here for these shows, man.
I know.
Tell you, the last thing. Oh, wait. Hold on.
Yeah, I was going to say, hit the lights.
Hold on. Let me do this. Watch this.
Well,
boom.
I love it.
There we go.
Perfect.
What a dork I am.
Well, you bring that up too, and that's so interesting that because the sentiment is below where we were in the COVID lows, right? I mean, we've dipped below that.
It's below the COVID lows. Exactly the point I was going to make for ADD out on the Guinness and the green lights. Like the sentiment was worse than the pandemic lows. It went back to 2011 when the U.S. lost our AAA rating on our debt. Mm-hmm. And then just for context, like the 2008, almost the implosion of the financial system was a 56.3 reading. And then there's another thing I can show you in terms of bearishness. Let me bring this up in terms of investor sentiment.
And I think that points a little bit to how, I mean, we've been so numb to kind of where we've been in the inflation. We've been in this like really stable inflationary environment for so long, and rightfully so in terms of what we're seeing now. I mean, between gas, groceries, you name, used cars, you name it. We're housing market. I wrote about the housing market and how crazy
Yeah.
that's been.
That was
I
a
mean,
good article, guys.
everything.
Check that out on the New Age site if you haven't read it. Really good. Ryan going through the process. He recently moved to Boston. Sorry to interrupt. The process
No.
of going through trying to buy a new house in the Boston market and the impact on borrowing and your buying power with rates going up. Really good article. Check that out, guys.
Yeah, it's wild. So everyone's feeling it, and that's scary because we haven't felt it in so long. But you can see, I mean, that sentiment happened before, Russia and Ukraine went to war, before maybe some of the full scope of the interest rate hikes. I mean, we knew it was coming again, but that sentiment of inflation and the fear of inflation is palpable, and it's real.
Yeah, it is. It is, and here's the data to show it. So this is some investor sentiment numbers. Okay, so there's a group that goes out. It's called AAII, and they go out and they survey a bunch of newsletter writers and analysts and publishers and blah blah blah, and basically they have the percent that are bullish on the market and up top, percent that are bearish in the middle, and then the bull bear spread. And it got down to a minus 30 reading, which was actually lower again than the COVID lows. So more people were bearish. And these are professionals. These are deemed to be professionals at the lows, at the market lows. They were most bearish, and the reading got below COVID lows. And this one goes back to 2019 and 18 when we were doing a lot of Fed rate hikes, and the market was in kind of turmoil, which I think is setting a precedent for what we're doing now, which I do think leads into that yield curve conversation, which I do want to talk about. So, do you want to start it off here and maybe tell investors and traders why they should care about the fixed income market, like why interest rates and yields matter to a stock market trader or an investor?
Well, and I was going to talk about this a little bit too, because, and it might have played out. I'm basing this on what the bond market was doing yesterday. It may have played out differently today. So I'm basing a little bit of what I was reading this morning and what was happening yesterday. But yeah, I mean, your point with the bond market, I'm going to take a bigger picture look at kind of that yield curve. Historically, and wrote about a few weeks ago too, that 2 and 10 yield spread once the 10-year comes, but usually the further out in a bond, especially for more novice or investors who aren't following the bond trends or kind of what that yield curve means. But typically the longer you go out that you're borrowing or lending, you're going to get a higher rate of return. Typically as a recessionary sort of signal, what happens is that there's a yield curve inversion, and those longer term yields in longer term bonds, the yield comes down below the shorter term. So, as an example right now, as the Fed is raising interest rates, that's going to go up on the shorter end of the curve. If the longer end, the 10 years, the 30 years start coming down and start going below, say the 2, that's an inverted yield curve. And that has historically shown or been kind of a leading indicator of a recession. And it primarily has to do with how people are buying bonds and flocking to safety, if you will, that they're buying more into the longer term because they're so fearful of what's kind of happening. And so that's kind of been something that's been talked about a lot recently, because even yesterday I think there was a little bit of a flattening in the short term, and that's just a 1-day picture. So I'm not basing that on any long-term trends, but just yesterday in I think there was a little slight flattening of that curve versus the stock market, which was going up, which was sort of kind of going in two different directions in terms of sentiment between the stock market and the bond market. And I think you have a longer term trends here, so I'll let you kind of dig into more of the technical analysis of what we're seeing and what we're talking about with regard to that yield curve.
Yeah. So again, going back to basics, guys, if a bond goes up, right? So if a bond price goes up, the fixed coupon that it pays, okay? So let's say it's $1,000 bond, it's a $100 coupon, let's say, so it's a 10% yield. If the bond goes up to 100 to 105, 110, that same that same fixed coupon payment, let's say $1,000 bond pays $100, let's say. So all of a sudden, 100 is a percent of $1,100 bond, a $1,200 bond, $1,300 bond. That percent goes down. So the yield, the percent yield will move inverse to the price of the bond, and that's what we're talking about. And watching CNBC, lately, so much being thrown around the spread between the 2s and the 10s. Now, 2 is a very short-term treasury. It's a 2-year maturity. It goes out to 10s, and it also goes out to 30. The Fed sells 30-year bonds. So generally, the longer you lend your money to the government, the higher percent they should pay. So shorter-term rates are generally lower than longer-term rates, and that upward sloping yield curve is what we call a normal shape yield curve. That's the shape of a healthy economy. And I'll put some more data behind that. In fact, let me see if I can do that quickly. I love this little stock chart here, this little yield curve from stockcharts.com. It takes me a sec to pull it up here. So where's our dynamic yield curve? I just had it up right there. Okay. I think it's a free thing there too. It's really cool. So, this is the shape of the yield curve. So this is the yield on a 3-month, 2-year, 5s, 10s, 20s, 30s. When it's low in the short term, and higher in the long term, that's a normal yield curve. What happens is when the short gets to the same level as longer term rates, that's called a flattening. And when it gets above, that's called an inversion, yield curve inversion. And this is a perfect example, right, for the global financial crisis. Fed was raising rates in the short term. Now, when the Fed raises rates, it impacts the short end of the curve down here. When it moves interest rates up, whether the Fed or the bond market itself pushes interest rates up, which means short-term bonds are sold off, yields are going up higher than longer term. That's called yield curve inversion, and that's attended almost every significant market sell-off. Watch, 2000, yield curve inversion. Tech bubble unwinds, Greenspan slashes interest rates very quickly to zero, and you can see that short end drop. That precipitated a housing bubble, market heated up, they had to raise short-term rates, yield curve inversion, bam. And then we get global financial crisis, yield curve down, yield curve normal. So then, as we're starting to move up, you're going to notice short-term rates stayed very pegged here through this rally, but we're starting to get a little bit of flattening. And there's something that I want to talk about here, which too many people are throwing this around, and I've been saying this. I was on CNBC Asia last night talking about it. I was on CNBC 2 days ago, CNBC US talking about this. A lot of people are saying there's yield curve inversion, Ryan, but it's only between the 2s, which is here, and the 10. The short-term rates, which is where the Fed operates, they're very, very much low. And Kelly Evans from CNBC just wrote a really nice article citing something I can link you guys to. It's saying not only is the yield curve not flattening, and I'll go to the other chart. What Ryan is saying is when the spread between the 2s and the 10s gets too narrow, that starts to indicate a recession is coming. But that's not exactly it, because the Fed is operating in the short end. They have a long way to go. Even if they hike 7 times as they're expected to do in this cycle, there's still going to be a normally shaped yield curve, which is not anywhere near the shape of the yield curve here and here, okay? And one thing I wanted to throw in front of you is if we go out, Ryan, this is the 2s and the 10s. There's a couple things I want to talk about with this. 10 is in orange, the 2-year yield is in blue, and the spread is here in purple. Now, the spread is dropping to 0.24%, which means there's only 0.24% difference between the 10-year yield and the 2-year yield. But if you go out here to the max, okay, as much data as they're going to give us. Okay, actually, let's go, let's start from 1980. And in fact, let me just do this real quick. There's going to be something that I hope I can make this point, that the yield curve is in a much different position now than it was. So basically, let me go out a little further. Let me go to 85 here. Okay. Sorry, I'll make my point here. I'm just trying to get the right scale. Okay, so the purple line is going to be the spread, okay? The purple line's the spread. And what you'll notice is the spread, and this is a point I want to bring up to you, Ryan. The spread up here, and I'll show you that I'm going to bring the S&P in, when the spread is widest is usually when stock market expansion happens. Okay, so let me just throw the S&P on here. This is going to be a busy chart, but hopefully we can do it. And let me take the 2s and 10s off. I'll just do the S&P and the spread. Basically, when the spread is in purple, is wide, is when the stock market expansion starts. Okay, so wide spread, stock market rally. Wide spread, stock market rally. Wide spread, stock market rally. The difference, I think, here is look at the starting point for the COVID recovery. It started way down here at a spread of only 1.6%, where typically you're up around 2.5, 1, 2, 3, 2.5 to 2.8. And there's some I think there's not enough people talking about this. Is why was the yield curve so low? Okay, and that means that interest rates, the long end of the curve, wasn't high enough. Okay, it wasn't high enough, which means longer term bonds weren't sold off enough. There's a consistent bid for bonds and safety, and I think that's two things. One, I think that shows that there's still a lot of people that are underinvested in the market, too invested in fixed income. And third, maybe in Kelly's article, which is really a good point, and she was citing another research analyst, I forgot who it was, he's saying maybe the Fed needs to hike more and all interest rates are going to shift up. Maybe the 10s are going to shift up significantly higher as we move back into a growth phase. People don't need the safety of bonds. And if 10s are going to really move up, then all of a sudden maybe we can get a sharp yield curve. That cash comes in. Maybe inflation is going to be a real issue. Longer term, people are going to sell those long-term bonds, which is going to spike that 10-year yield, which is going to give us a normally shaped yield curve. So maybe the whole curve shifts up, and all I hear about is 10-2 inversion, coming recession. I'm saying there's so much more to the story. Sorry to go on that rant.
No, it was good, and I think you make a good point in terms of the starting point here, and kind of some of the disruptions and some of the differences, right, that are important to take into consideration. And even you go back the last 25, 30 years, we've had 5 different interest rate hiking environments. Not every one of them has led to recession or
Right,
market
right.
collapse. I think out of the 5, only one really led to it. That was the end of the 90s into the dot-com crash. We went through it from 2015, 2016 through 2019, I think was the last one,
Mm-hmm.
or maybe 2018 was the last hike. Um, and the markets continue to do well. And we've talked about, yes, the impact is a slowing economy. Like that is what, because with inflation where it's at, the only way to kind of reel that back is to somehow, slow down an overheating economy. And
Yep.
that's really what the goal of it is. And when you take that into account, yes, it's scary to kind of take it into perspective, but we're also starting at zero interest rate. I mean, we are at zero, and
Exactly.
that's the starting point. And when you look at that 2 versus the overnight Fed funds rate, it's a much bigger spread, and there's a lot more room to grow there. And just because the Fed is raising rates right now doesn't mean that's going to necessarily impact every one of those positions or points. And I think kind of when you take a step back, right, we've recouped almost all the jobs from COVID that we lost. We talked about it, I think last week or the week before, but we lost a little over 20 million jobs. We've almost recovered them all. Uh, Earnings and unemployment rates very solid. Wage increases have been really strong. I mean, you think about COVID and kind of the impact of the um, the money that the Fed was putting in and the government was adding to the economy with unemployment benefits and everything else. I mean, the corporate America in our economy was forced to start raising rates. We're seeing continuation of that. Maybe it's in. We touch upon this as well. It's not as high as the inflation number is right now, but even though I don't think it's going to be like a couple months transitory, but this inflation data is still in a big picture somewhat transitory because it's still a big effect of the supply chain issues from COVID. It's going to probably get worse in the short term because of what's going on in Ukraine and Russia due to oil prices, which weren't even baked into it. But wage increases are pretty strong right now, and that's a really like sticky indicator of strength in the economy as well. So, and then the last thing, which we haven't even talked about, but our balance sheets and the savings rates that most Americans have had over the last 2 years, yes, it's been coming down since the end of last year, but we're starting at a much better position. And I think the hopes right now, and I think some of the sentiment that came out of the Fed yesterday is that we have a cushion right now. We have a strong labor market. We've talked about that other word, recession, as well as stagflation. Right now the labor market is quite strong. Very tight labor market, good wages. Again, maybe not keeping up with inflation, but again, this inflation number, why it's going to be high, and it's going to be high for the foreseeable future, is probably more of a consequence of everything that's going on globally. That is going to shake out, right? It may not happen overnight, but it should shake out over the next 6 to 9 months, maybe by the end of the year. And so with all that, and then with as strong as personal consumption and consumers' balance sheets are, can that get us through some of this disruption and some of the points that historically may have been pointing to a recession? But there's other factors, as you said earlier, that in my mind, I think can get us through this. And with you were looking at the semiconductors earlier chart, we've had a pullback in a lot of stocks going back towards the even the middle of last year. This market pullback hasn't just happened over the last 2.5 months since the start of this year. It's been happening for quite some time, and to me that's brought, and we've talked about this a lot separately and on our videos, but that's brought forward looking earnings ratios and just the fundamentals of a lot of these companies back in line to kind of where they should be. So far, it's sort of been like a healthy pullback, and it's gone a lot further back than I think what the broad market has done. And I think that's healthy to a certain degree.
Yeah, I'm with you. I'm absolutely with you. And I think we could start to look at some of those. The idea that again with I think a lot of people are just throwing out yield curve inversion. We're coming to a recession. You said we have strong growth, and I just can't deal with the comparison of the stock market from the stagflationary 70s. So many people are throwing that out there that we're going back into a stagflationary environment, which means high inflation but no growth. Okay, that's what the word stagflation means. Another word that people are throwing out there is disinflation, which is inflation happening but at a lower or a decreasing rate. So if you look back, you look back at the 1960s and 70s, and as I said, a lot of people are trying to say that we're going into that kind of environment. First, let's just take a look at the stock market. So let me just pull this chart up, which I think is pretty interesting. You look at the stock market performance of 1965 to 1980. I just took a 15-year period. It's up 17% in 15 years. Okay, number one. Let's take a look at the last 15 years in the S&P, 260%. Okay, so we have massive inflation in the 1970s. You obviously had a big energy surge. You had huge unemployment that was going up around 10% pretty consistently. We have almost maximum employment, as Paul said. We have 3.8% employment. Wages continue to rise. Consumer is weathering this economy, this inflationary pressure very well. So I have a really hard time saying we're going into recession. So let's take a look at some of the earnings here from some of these companies. This is EPS. So here is earnings per share on the S&P. So let me bring this one over. So earnings per share and the S&P. Okay. So this goes back to 2000. Guys, per share. So if you do the aggregate earnings of each of the 500 companies in the S&P, we're at almost $50 a share, which you can see is clearly a new high. I mean, well above where the S&P was back in 2000. They're making $12 a share. Now they're making $50 a share. The forward looking, okay, so this is current earnings reported. Markets also do what they call forward estimates, and they look at what they expect to have. So the orange is the EPS I just showed you. Purple is expected EPS going into 22 and 23, up around $61. So we're looking at, the markets are pricing a 20% earnings growth. We're going to put on another $10 of earnings per S&P share over the next 2 years. Okay, 20% growth, and you say we're going into recession. And again, I just don't buy this yield curve flattening bit, because again, I think they're forgetting that the very short end is where the Fed maneuvers around the 3-month to 1 year interest rate, and that's still very much very low. So that's forward EPS. And the other thing is margins. Okay, I borrowed this chart, and I'm going to give him credit. It's Ed Yardini, who does really good research here. This is corporate. Okay. No, let me bring over this one here. Yeah. So this is corporate profit margins divided by GDP. So what corporations are making as what percent of profits into GDP? You can see, look at the scale, 60s, 70s. You know, they were making 6-7% margins back in the 60s, the 70s, and 80s. You go up into the 2000, we're going around 6-7%. Guys, we're up around 11 or 12%. Companies are twice as efficient right now than they were at the tech bubble in 2000. They're making more per share. They're more efficient. Technology digitalization, which is why I believe we're seeing massive NASDAQ outperformance compared to the S&P. We're seeing a little bit of rotation into value, but for all these reasons, companies are running more efficiently. So this is why, Ryan, we're new age wealth. This is the new age. This is the digital information age. There's so much stuff being thrown at investors. It's hard to know which way is up. And there's so much scare tactics out there that are scaring people out of positions, costing people valuable ownership of stock. And unfortunately, you have so many people coming to us, right? You've probably heard us if you've been on the show before, to the viewers. So many people are coming to us underexposed, having missed out on a lot of significant gains. And the same thing is happening. The market is off 15%, and everyone is certain that a 40-year downtrend in interest rates, a massive uptrend, generational bull market is over. There's so many people saying recession is here, sell all your stocks. And I just think it's another example of such a noisy digital information age costing people valuable positions.
Yeah, and I love seeing that. I love seeing the efficiency of corporate America. And you brought up what they looked like versus 2000. I mean, even in terms of the tech space, much different companies today than in the past. And when we're talking about, you're looking at earnings per share, when you look at forward P ratios, we're still probably a little bit inflated from, the last 20, 25 years in terms of what the average has been, but it's much more in line right now in terms of how we've seen this pullback affect fundamentals, right? If because you talked about it earlier, we talk about fundamentals as a basis for some of the analysis, technicals, and kind of looking below the hood, and there's a lot of different ways to kind of look at what the market's telling us. And so, on top of all that, we've had a pretty strong consumer spending report that just came out. I think what's going to be important, we talked about this, and I don't want to get too far into it because we'll probably be able to talk about it in the next couple of weeks, but towards the end of the month, we'll start seeing the service spending, right? And that's more on, leisure, travel, going out to dinner and seeing what those numbers are going to look like. And you pointed out in our conversations offline, just how well some of those companies have done in the last, I think yesterday they were doing great. I don't know what they're doing today per se, but a lot of strength in kind of those, travel and more on the service side. And that's going to be as we're coming out of the winter slowdown with Omicron and everything else, the rest of the country feels like there's some normalization going on. And I think that's going to be a good thing. I think inflation has scared a lot of people, and you may see some, cutbacks just as this thing all shakes out with gas prices, grocery prices, but there's still a lot of spending. And to your point of the markets being forward looking, when you see some of the upticks in some of these other areas of the market that are more, travel, leisure based, I think that's a good sign in terms of what the market's indicating there.
Yeah, yeah, you're absolutely right there, and that's been sort of the bellwether group is been the travel stocks. It's the hotels, it's the gambling stocks, it's airlines, it's Expedia, which we hold, it's Bookings.com. You know, these are the names that are really given a good workout here because I got hammered during COVID. And then as the reopening came, as COVID started to get under control, these have been ripping on the upside. Then they got hammered again when crude oil went to $130 because nobody wants to, I mean, pay. Did you know? I didn't know this. My wife drives a Denali, it's a suburban size. Did you know that there's a stop loss on gas on gas stations at $100? I never knew that. I never filled up anything. I
Yeah.
got right to 100. I said, "Oh wow, that's kind of weird." I got in my car and I realized it was only three quarters full. Like $125 to fill up my wife's car. It's like holy bananas.
Yeah.
Anyway, what was my point? Oh, yeah, inflation is causing very important sort of divergences in the market. And do you mind if we kind of go from that inflation topic and say one of the sectors that were overweight? And Dave Hildebrand there was asking about financials. We are very overweight financials, and I'll give you the data if you don't mind. So, so that is holdings. Okay. So this is the growth portfolio. Okay. And the allocations in the financials right here, we're at 11.5%, which I think is going to be roughly a market neutral. So I think that's the financials should be about 12, 13, 14% of the S&P right now. This is in the growth portfolio. And again, that's very odd to have such a high financial exposure because the interest rates going up and that earlier conversation we had, especially if we do get an inflationary scare, markets continue to grow, the consumer can weather it. I think that longer end of the curve is going to steepen as longer term bonds go off, and that helps banks. Okay, banks. Oh, sorry. Let me get this up here. Banks make money by what's called net interest margin. So they borrow in the short term. So when you put your money in a bank, they pay you less than 1%. What they're doing is when you put that money in the bank, they'll pay us 1% or less for leaving it there. Then they go and lend it out in a longer term auto loan, housing loan, some kind of loan at 3, 4, 5%. So they pay 1, make 4 or 5. That 3% spread is their profit. So there was just a study that just came out, and they do this quarterly. The average net interest margin, the average spread that banks are making is about 2.68% right now. And again, it goes back to that conversation. You know, forget about the 10-2 spread. Look at the 3-month. You know, look at where the federal funds rate is, which is now a quarter to 50 basis points. Like it's still nothing. So we do have the ability for financials to continue to do well. So actually our biggest holding, let me get into the growth portfolio. Our second biggest holding, sorry, this is going to be the dividend, is Charles Schwab. And I don't know, should we like disclose because we custody our money with Schwab? I don't know if that's a conflict or not.
I'm not sure. I'm not sure it's a true conflict, but it doesn't hurt to say it, I guess.
To throw it in there. Yeah, yeah, yeah. And sorry this is right on your head. Let me see if I can fix this position. And guys, when I'm looking around, I'm not spacing out, not listening to my partner. I'm running and getting all these charts ready here. Let me see if I can get this off here.
And I was reading too over the last couple of days it's kind of interesting because, you know, as rates go up, you're wondering, especially as a, you know, your personal interest rate, how it affects you as a borrower, as a lender, whatever it may be. They're saying because there's so much, again, we're talking about how much savings in individual savings are up in our country right now, how much cash the banks are sitting on. You're probably going to see rates that you're getting on savings, CDs. It's probably not going to go up as quickly as you're seeing it happen in the market because banks are not incentivized right now to raise those rates. So if you're wondering,
Yeah.
hey, why isn't my savings rate going up, or why aren't CD yields going up right now as the Fed is raising interest rates? Banks are sitting on so much cash. You're going to see a slowdown in them raising rates there. So just kind of one aspect, you know, we've talked a lot about the markets, but how is interest rate going up from the Fed? How's that going to affect us as, either consumers, savers, borrowers, whatever it may be. So it's an interesting kind of point right now in just the current environment that banks in our country are in.
Yeah, that's a great point. It's a great point. And as I was saying with financials, so in the dividend portfolio, we have, in terms of financials, what's our holding? We're at 18% right now in financials in the dividend portfolio, and our second largest holding, and I'm sure you guys are top holdings here, which is fine. So we have a 4% allocation, target allocation right now in Charles Schwab. So obviously a brokerage, wealth management, custodian, which is bringing a lot of capital. They just bought TD Ameritrade. So we were going to be custodying our wealth management business with TD, wound up with Schwab, which has been great. So they're bringing a ton of money, and they're doing the exact same thing. Those customer balances that are out there, they're making money on that spread, and I think they're a little bit more recession-proof than some of the banks that are more focused on loan centers, because loan growth will drop off if we do go into a recession. So Schwab's, right, I think, pretty insulated there, and then we have some good regionals as well, some regional banks which do benefit from higher yields. So, I know we have Zion, we have Key, which Key Bank is one of the larger regional banks. So we do have some good financial exposure in there as well.
And I think that's a good point, because that question comes up a lot with either clients or prospects in terms of how are financials going to be impacted. And I think especially in terms of a rising interest rate environment, not all banks and financial companies are created equal. I think typically the regional banks do better on that interest spread. Some of the larger ones, all these banks get revenue from different pockets, and so a rising interest rate environment does not treat every single financial institution the same way. And I think it's important in the work that especially you're doing on the portfolio side is looking for those opportunities of those companies that are going to benefit more in this type of environment versus some of the larger banks that maybe are making more money on transactionary revenue and other avenues of income streams versus more of kind of how it's impacted by interest rates. So without getting too much into it, just wanted to bring that up because I think it's important, especially as we look at some of our holdings.
Yeah, absolutely. Yep. And I think financials are important, and then energy as well. Energy continues to be a big holding in both our growth and dividend portfolio. So if we look at allocations here, this is the dividend portfolio. Energy's at 8.5%, which is double the market weighting of the S&P. So, even though crude oil's come off from 130, we're back below 100, and it's actually nice to see sort of an inverse relationship as crude oil's moving down. Stock market's moving up, which is not always the case. A lot of time commodities are correlated. So I think energy has been a good run for us. But I do think we're going to look to begin to scale back in energy. And actually, I do think we're going to look to increase some of our technology exposure. As I mentioned, we like semis, we hold semis. The rally back yesterday was really led by it was a lot of consumer discretionary, but also technology, and specifically semiconductors. NVIDIA looks good. AMD looks good. A new one I'm going to put on our radar, which is local to us, is Global Foundries, GFS. They just relisted. So we'll be looking to rotate back into tech, and I think the value trade has been good, and we put financials and energy in the value trade. But I think it might be time to look the other way. So I'll just give you the reading here. Let me just go to growth. Allocations. So energy is 11% here in growth, and dividend was also 11. So it's about 4% in the S&P. So heavily overweight, and possibly we'll look to scale back on that. I did have a question on the technical position of the market. Let me see if I can do that. Here's one. We also hold Tesla. I'll just give you a quick, crazy technical chart, send you guys on the way. For my old life, I was kind of joking on Twitter. I don't know if you saw that, Ryan, that I'm kind of going in the closet in terms of being an Elliottian because I'm tired of explaining it. And people screw it up all the time. I'm just going to do it in my dark office here by myself. But you just look at the longer term trend in Tesla, and it looks amazing. It's a big weighting in ours. You look at the depth of the correction here, sort of getting in the gory details here. This is very much a complex, very textbook, complex Elliott wave correction. I believe it's over. I think we broke trendline resistance, so watch for Tesla to come back. Nvidia's got a very similar looking chart, so we could see some fun times again here in the stock markets. But best count, I think somebody was asking. I do think we are in a corrective pullback here. I think this was wave 3. I think we're pulling back into a wave 4. We're going to move higher in wave 5. I do think we'll make a new high, and at that point we will go into some consolidation in wave 4 that takes us out a couple years into the future. So we did begin to put money to work yesterday. We had, let's say, of the money we had on the sidelines for clients, I would say we put about a third of the capital available to work for clients who wanted to do it. I'm happy to do so. I added a little bit more this morning, and I think it's just got to be. Well, he's just got to have the ability to trust that the underlying economy, as Ryan and I are trying to describe to you, is still strong. Companies are making money. We're coming up into earnings season in about another 3 or 4 weeks. The Ukrainian-Russian situation is horrible. Hopefully that comes to a resolution soon. We can focus on more of the underlying economy and earnings without spiking oil and supply chain issues from geopolitical constraints. And I do think we're going to return to that. So just encourage you to set the fear aside a little bit. Realize what you're trying to do. If you're an investing time frame, this little 15% pullback will be a distant memory, I think, very soon. If you can just have a good plan, if you can be in the right stocks, this should not be overly concerning. Anything you want to close on there, Ryan?
No, I think you said it well. I think in this type of environment, I mean, frankly, it's confusing. There's no doubt about it. There's indicators in every which direction. Every day, even the volatility in the market. Monday early in the week, we're getting some sell-offs. Last 2 days, we're having some strength in the market. It's really hard to sort of make sense of everything that's going on, and having a long-term plan, sticking to it, being disciplined, having that plan, and you can have different strategies to do this, but just being disciplined in what your approach is and trusting that approach is so important right now. So again, in this time, if you're uncertain of what to do, or you're kind of just sitting on the sidelines, just not unsure of where to go or what to think of these markets, I mean, reach out to us. Work with your advisor, or give us a call, because we're having these conversations with people all the time, and it's really, and I've seen, and even especially I go back to COVID because it was such a dramatic drop in time frame, but working with people that had a plan, even when markets are we talked about selling off 8-9% in a day, there is some reassurance that having that plan and having a long-term plan gives you a lot more confidence than kind of sitting there saying, I don't know what to do. So that's where, in times like this, getting outside of just the technicals of what the market's doing, bigger picture, having resources, having people working by your side, guiding you through this, working together it's critically important.
Yeah, and I hope you guys don't mind. I hope this isn't unprofessional, but I think it's time to pop this. And I was having a discussion. I dropped in, oh, don't explode. That's what I get for popping a Guinness on air. What an idiot. Yeah, trust me with your money. Come on in. We got it all under control. We're fine. I was having this discussion, and we're going way over, but it's fun. After this, our friends were just popping through the window there. They're trying to pull us downtown Saratoga, and we'll go do a little St. Patrick's Day party with the family. But a lot of my audience, Ryan, that I brought to you is in the trading world, and it's so important to be able to compartmentalize your trading activities from your investing activities. And it took me a long time. It took me a good decade to be able to do that, I think. To just have conflicting views, but on different time frames. You can be bearish in the short run and have positions on, if you are a trader, that are looking for the market to go down. But your longer term money needs to be in a separate account. It needs to be thought of differently. It needs to be controlled differently. And I find in a couple traders who have come to us say, Todd, Todd and Ryan, I want to continue to trade, but you take care of my longer term money, because a lot of people can't compartmentalize and can't separate out or bucket their two different activities in the market. So just think about that. Think about that, and if you want to continue to trade, please do. But if you have a hard time setting all the emotions aside with your longer term money, which I'm sorry to keep going, but right, working with retiree age clients, there's a psychological shift I'm learning. This is something that you already know about. When all of a sudden the earnings from your job is no longer there, that puts a little bit more pressure on the 65, 70-year-old investor who says, I used to have an income source and now it's gone. That changes the risk tolerance quite a bit. And I find that there's several of our clients who I kind of watch go through that transition, and I think it really helps to have someone doing it for you.
Yeah, it's a great point. I think that's a good one to end on. I've been working on a piece, probably not this week, probably next week, but just, markets, and because, again, it's easy to kind of look at them and say, this is what should happen in the markets. Markets are very irrational. I mean, when you just take a step back and look at the charts and what's going on, you want to go off fundamentals. You want to go off saying that, everything should be efficient and prices should be where they're at. Based on all the information that we have as investors and as public companies. But the markets can be so irrational, and it's hard to make sense of that at times. And that's where being a little bit more longer term focus, I think does help. So I'll leave it at that.
Yeah, markets are predictably irrational. I mean, they drive the smartest people insane. I mean, I'm very average intelligence, and I think that actually serves me well in the market. So
all right, Part.
Good show, man. I really appreciate it. Happy St. Patrick's Day. Anything happening?
Good stuff today.
Anything in Boston going on?
I mean, Boston's big for St. Patty's Day. Big Irish following. I'm off to Kung Fu though now, and maybe celebrate later on today. But yeah, we got Kung Fu today. So
right on, man. Right on. Hi to the family and viewers. Thanks for checking in. Don't mind, hit that thumbs up button if you got a little bit of value from this, and don't forget to share if you would on the social media. Get the word out here on this brand new show. Ryan, thanks, man. We'll see you guys next week.
Yeah, we'll see you. Have a great day.
You too. See you, bud.
Bye.